The next estimated liability that we have is warranty expense. So a warranty is something that as a seller we include with our products that we are obligated to replace or fix it if it fails to perform as expected, usually within a specified period. So you might have purchased a car sometime at one time that came with a warranty. Uh, Sometimes a lot of technology has a warranty that within the first year, if it completely fails to function, they'll replace it or they'll fix it. Amazon Kindles come with a 1-year warranty, so if anything happens to them within that first year that they stop working, Amazon replaces them. No questions asked, they just send you a new one. So this expected warranty expense, we have to record an estimate of our warranty expense when we record the sale. And we report that warranty expense as a liability until a customer comes and uses it. So then they bring in a broken thing and we have to provide a service for that or a new piece of equipment. So in this example, we have a car with a 1-year or 12,000 mile warranty. So in the 1-year or a 12,000 mile warranty, that means that that warranty will expire either after 1 year or after the car hits 12,000 miles, whichever happens first. So if I only drive it 10,000 miles in the first year, then I get a 1-year warranty. Where if I drive it 17,000 miles in the first year, then I only get a warranty to 12,000 miles. Past experience, so our historical information gives us our estimate. So we indicate that our warranty expenses average 4% of a car's selling price. So when we record the sale of the car, we also record a 4% estimated warranty liability. So then we have on January 9th, our customer has returned the car for a variety of repairs, and the dealer replaces those parts and writes that off to the estimated warranty liability account. So contingent liabilities. Contingent liabilities are liabilities that we get based on a contingency. Sometimes these are a lawsuit. So how we determine if we have a contingent liability and whether or not we're going to record that contingent liability in our accounting records. We have this decision chart. So if it is probable that in the future we are going to create a liability and we have a fairly good idea of what the amount is going to be that we're going to have to pay, we will record a contingent liability within our accounting records. However, if we're pretty sure that the amount that it's going to happen, we're going to create a liability from this, but we can't estimate what the amount is going to look out, then we're just going to disclose it in our notes. We also have, if it's possible that we could have a contingent liability from an event, we would just disclose that in the notes. And if it's a remote possibility that we're going to have a contingent liability, then we don't disclose it at all. So what are some possible reasons for having a contingent liability? One of the main ones is legal claims. If we have been sued by a customer, and then if we're being sued, we're very likely going to lose the lawsuit, and we have an estimate for what we are going to pay when we lose this lawsuit, then we can record it in our accounting records. Otherwise, we would just put a note in our annual report that says We are currently being sued by a customer. We are unsure of what the outcome of the case is going to be at this time. A debt guarantee. So this is if we're if it's probable that our debtor is going to default in their payment, then we're going to report that as a liability. So these are if we've guaranteed debt. So for example, if we'll find out in the next chapter, like if we take out a mortgage against property, then we have a debt against that property. And if we don't match that debt, or if we default, then they will come and take the property back. So we have this liability against our property. So we can make other guarantees of financial obligations. We can also co-sign loans for people and then say, if I co-sign a loan to help, say, my brother buy a car, then I'm making a guarantee that if my brother misses car payments, I am going to become financially responsible for them. So as long as my brother continues making car payments, I'm just going to report that in the notes. Like, yes, I've co-signed on a loan. It's possible that I'm going to be responsible for this debt, but unlikely at this point. However, if my brother loses his job and it looks like he's not going to pay his car payments, then I would have to record that in my accounting records as a liability that I knew was probably going to happen, and I was going to be financially responsible for it. Any other contingencies can be caused from environmental damages, tax assessments, insurance losses, if we're being investigated by the government for anything, and this can be a whole host of things. And we can't necessarily say, okay, so let's think about the derecho that we had in August. We can't just record and say, we're pretty sure the state of Iowa is going to have some kind of natural disaster and we're going to lose money because of it, so we're going to record that in our accounting record. However, once the derecho occurs and we have an estimate, so we have a financial estimate of what that loss is going to look like, but we're not 100% certain, we could record that as an estimate for a contingency. Other things, we already talked about some of the other things, and then uncertainties. So uncertainties from future events are not contingent liabilities because they're future unknown events. Okay, so like I said, just because we have a tendency to flood in Iowa, we couldn't record a yearly contingency for a flood. So that's an uncertainty that we can't record for. We pay insurance for that. That's our risk mitigation for that. The same thing if we assume somebody's going to sue us someday for something, we can't just record that as a contingent liability. However, if we've received notification that we are being sued, then that would become a disclosure. If we were at the end of the trial and we were pretty sure we were going to lose, then we would record that in our accounting records as a contingent liability. Now we're going to talk about just a little bit more about some payroll terms and reporting. So we have different payroll reports. So you might have at some time filled out forms to have things withdrawn from your payroll. You filled out all of these different forms for the IRS that say, yes, this is my reporting type, whether I'm single or married or have dependents. This is how much I want you to withhold. Then your employer records your payroll for the entire year. They keep a payroll register. They have employee earning reports. they issue checks, and then at the end of every year, they're going to issue you a W-2, which has all of the information on it that says how much you earned, how much was withheld, and it also includes the different amounts. So if you withheld stuff for health insurance, that's going to be in a box on your W-2. If you withheld for retirement contributions, that's going to be on your W-2. Then the last thing that the textbook talks about is corporate income taxes. So corporations also have to pay taxes on income. So we would have this income tax expense and income taxes payable. So on January 31st, we accrue our January income taxes, and then on April 10th, we pay quarterly estimated income taxes. If we're paying estimated income tax, it is because a tax accountant has looked at what our potential liability for taxes is, and they give us an estimate that we pay on a quarterly basis. So quarterly taxes are due in January, April, October, then it must be July for quarterly estimates that are due. So this usually happens if you, for one thing, if you greatly underreport your income taxes for several years and you have to pay in a lot, then the IRS will come back and say, okay, you keep underreporting your income taxes that you have to pay. Now you have to do estimates and you have to pay us. And then if you overpay, we're going to give you a refund. So anything that we've talked about in this chapter with tax liabilities, we're going to look at mostly as informational outside of the salaries taxes, and then they'll be expanded upon if you take tax accounting in future years. Also, contingencies, we just introduce them in this chapter and say, yes, contingencies exist and there are different reporting requirements for them, but actual accounting for and planning contingencies goes into much further detail in intermediate accounting if you move into intermediate accounting. And that is the end of chapter 9.